what I'm going to try and just explain is if you only take one thing away, I'm not going to go through how the credit crunch happened. I'm going to look at a growth model that doesn't work anymore. The growth model of the last 20 to 25 years, I argue, is in crisis and has in fact collapsed. I'm going to just try and show you this in a series of graphs. Now, unfortunately, they're in black and white because that's easier to see. That's my email address, by the way. Let me try and keep the audience engaged. I know it's a bit difficult, but I'll try and stay through here. If I can drift over to one side, show. Okay. We all go black and white maybe. I might ask you to just put us into colour. In fact, would you mind just progressing the slides? They're quite quick. Right, that's the talk is not mainly, it focuses on America. Because America is where the model was its purest. We follow the American model. So did some other Anglo-Saxon countries, so did Spain. That's US GDP in the post-war period, since 1952. And can anybody spot anything about that graph? Are there any graph readers here who can tell me about a trend? Is there anything noticeable over time?
That's variation.
What?
It starts with big variation and...
Yeah, or you say amplitude is big, and then it goes narrower. Look, that's what happens to the instability in growth in the USA. If we just run inflation, you can see this easier in colour. The grey line is inflation. Look what happens there. The 50s and 60s, low inflation. End of the 60s, it takes off. The two spikes and the two oil price spikes, and then bam, back again. The right-hand scale is a percentage, and it's true for both of them. So you get lowish but steady growth, and you get low inflation since the early 90s. We move on. Ben Bernanke called this, the Great Moderation. And he said, well, why did we get it? There's three reasons that it might be. Good luck, Soviet Union collapsed, as Ben Bernanke believes to be good luck. Or structural change in capitalism, rising globalization. Or was it policy enacted by people like Ben Bernanke? And I'll let you guess which one the main explanation was. It was, of course, policy enacted by people like Ben Bernanke. Low interest rates, the Goldilocks economy, the Great Moderation, or as Gordon Brown put it, the end to boom and bust. This is what they believed they achieved through interest rate targeting. Right, next bit. Keep going. Let's look at that graph again. To me, it always reminds me of and we will need colour here, it reminds me of a patient who suddenly gets better. You can see 8, put it back to black and white, there's 8 recessions in America from 52 to 91. Okay? Some of them quite deep. And then since the early 90s, there's just 2 recessions, the 91 recession and then the dot-com recession. And even in America, look, it doesn't really dip much below 0. But if you then animate the graph of household and company debt, which again is a terrible, you can see it easier in colour. That black line, I'm afraid, is not good because I didn't design it for being shown in the room with skylights. But you can see what's happened. It's gone from 100% of GDP to 350% of GDP. That is immense. It wasn't Ben Bernanke and his policy, or rather, Ben Bernanke and his policy, and Gordon Brown and his Kane Clark and their interest rate targeting, I argue, was possible because debt simply flooded into the economy. Let's move on. There's 2 signal moments where the graph hikes, it turns. 79, the onset of neoliberalism, and 98, the take-off point of the dot-com boom, and what we call, and what I will refer to as the global imbalances after the great Asian catastrophe of 97. Keep going. Okay, so just keep pressing it. Okay, right. So I call this the last 10 years is what we're going to look at from 98 onwards, the debt decade. What's the definition of an asset bubble? It's where assets, which can be shares or tulip bubbles or companies in the 17th century, trade at high volumes at prices much higher than their intrinsic value. In the 17th century, Amsterdam tulip bulbs did this. Now, what we've got here are a series of asset bubbles over the last 10 years, fueled by this debt and by the relative stability of the economy. First of all, .com. What I've done with these graphs is I scan graphs in, and then I lose all the data, and then just look at the shape. And so the thing to look at is this 5 times magnitude. I stretch and pull in PowerPoint and Photoshop until they all look, you know, until their magnitude compares to each other. So that's the Nasdaq over the last 11 years. That's what happens. .com, boom, bust. I mean, it grows by about 5 times magnitude, and then it falls back. Then, asset-backed security. These are the things that crash the economy. The rise of taking mortgages on credit card debt or car loans, bundling them up, we'll look at it in a minute, and then selling them on to the investment community. Again, the value of those in circulation quintupled as it rose towards the middle of this decade. So we'll look at the final one. Again, a bit of a shame, it's just flip it onto colour. You can see, you can't even go back. There's another little black line here that is commodities. If you go back to black and white, you can see it easier. Anyway, we'll come on to that anyway. So there's a commodities bubble building here, and we'll see what happens to that. So you get 3 waves of asset bubble over the last 10 years, driven by debt, driven by easy and cheap and money. Keep going. And then, hold on, go back one. This is just completes the graph. That 5 times magnitude, that's the graph you've just seen. Assets under management by hedge funds, 10 times in 10 years. And then the next one is credit default swaps in circulation. It struggled to get above $1 trillion because it was a dodgy market in the first, it didn't exist until '97. Credit default swaps, we'll talk about what they are. It's just a bet made on your business partner going out of business, and the volume of them in circulation, I don't know how many times, tuple it is, but 58 times what it was in 2000. Right, this is a decade of crazy asset price inflation. What caused it? I argue it was the low interest rates that they were able to live with, and a savings glut. Now, in a longer talk, I'd run through quite a bit more of this. Martin Wolf's book, actually, is very good about what we call the global imbalances and the rise of savings in Asia and its ability to drive low interest rate policies in the West. Just moving on a bit, let's see where we go now.